You've saved up some money, you're ready to invest, but now you're staring at two doors. One says real estate, the other says stocks. Which one do you walk through first? Real estate feels solid, you can touch it, live in it, rent it out. It's the kind of investment your parents probably talked about. Stocks, they're numbers on a screen, fast-moving, sometimes confusing, but they've made millionaires out of everyday people. So what's the better move for someone just starting out? That's what we're here to unpack. We'll look at how each investment works, what kind of returns you can expect, how risky they are, and most importantly, how they fit into your life. Real Estate 101, the tangible wealth builder. Real estate is one of the oldest forms of investment, and for good reason. It's physical, it's familiar, and it's something you can control. When you buy property, you're not just investing in bricks and mortar, you're investing in location, lifestyle, and long-term value. Types of real estate investments. Residential properties, these include single-family homes, duplexes, townhouses, and condos. You can live in them, rent them out, or flip them for profit. Commercial properties, think office buildings, retail spaces, and shopping centers. These typically require more capital but can yield higher returns. Industrial properties, warehouses, factories, and distribution centers, often leased to businesses for long terms. Raw land, undeveloped land can be held for appreciation or developed into residential or commercial use. Rate real estate investment trusts. These are companies that own or finance income-producing real estate. You can invest in them like stocks. Why real estate appeals to beginners. Leverage-friendly, you can buy a $300,000 property with just $60,000 down. The bank finances the rest, and you benefit from appreciation on the full value. Cash flow potential. Rental income can provide monthly returns, especially if your mortgage and expenses are covered. Appreciation over time. Property values tend to rise, especially in growing markets. Tax benefits, depreciation, mortgage interest deductions, and 1031 exchanges can reduce your tax burden. Control, you decide how to manage, improve, and monetize your property. But it's not all sunshine and equity. Real estate requires maintenance, management, and patience. It's not a get-rich-quick scheme, it's a build wealth slowly strategy. Stock Market 101, the abstract powerhouse. Stocks are the gateway to owning a piece of the global economy. When you buy shares, you're investing in companies, some of which shape the world we live in. Types of stock investment. Individual stocks, buying shares of companies like Apple, Tesla, or Amazon. ETF exchange-traded funds. These bundle multiple stocks into one investment, often tracking an index like the S&P 500. Mutual funds, professionally managed portfolios that pool money from many investors. Index funds, passive funds that mirror the performance of a market index. Dividend stocks, these pay regular income to shareholders, making them popular for passive income seekers. Why stocks are beginner-friendly. Low barrier to entry, you can start with as little as $10. Liquidity, stocks can be bought and sold instantly. Diversification, spread your money across industries and sectors. Compound growth, reinvest dividends and watch your portfolio grow exponentially. Passive investing, with index funds or robo-advisors, you can invest without daily management. Stocks are fast, flexible, and data-driven, but they're also volatile. Prices can swing wildly based on news, earnings, or global events. Emotional investing, buying high, selling low, is a common trap. Comparing returns, who wins historically. When it comes to investing, returns are the name of the game. You want your money to grow and ideally grow faster than inflation. So how do real estate and stocks stack up over time? Historical performance. Stocks, the S&P 500, which tracks 500 of the largest U.S. companies, has averaged annual returns of around 10–11% over the past century. That includes bull markets, bear markets, crashes, and recoveries. If you had invested $10,000 in the S&P 500 in 1980, it would be worth over $800,000 today, assuming you reinvested dividends and didn't panic sell. Real estate, residential real estate tends to appreciate at 3–5% annually. However, when you factor in rental income, tax advantages, and leverage, total returns can reach 8–12% per year. For example, if you buy a $300,000 home with $60,000 down and it appreciates 5% annually, your return on the down payment is much higher than 5% thanks to leverage. Volatility and stability. Stocks are more volatile. Prices can swing wildly based on news, earnings reports, interest rates, and global events. One tweet can send a stock soaring or crashing. Real estate is more stable. Property values don't fluctuate daily. They're influenced by local market conditions, interest rates, and supply and demand. You won't wake up to find your house lost 20% of its value overnight. Compound growth versus leverage. Stocks benefit from compound growth. Reinvesting dividends and gains leads to exponential growth over time. Real estate benefits from leverage. You're earning returns on the full value of the property, not just your initial investment. So who wins? It depends on how you measure. Stocks may grow faster, but real estate can offer higher returns on invested capital, especially when leveraged wisely. Risk and reward, what could go wrong? Every investment carries risk. The key is understanding what those risks are, how they compare, and how you can manage them. Let's break it down. Real estate risks. Tenant troubles, late payments, property damage, or vacancies can eat into your cash flow. Market fluctuations. While real estate is generally stable, it's not immune to downturns. A local economic slump or oversupply can reduce property values. Maintenance costs, leaky roofs, broken appliances, and landscaping aren't free. Unexpected repairs can be expensive. Legal issues, landlord-tenant laws, zoning regulations, and property disputes can be complex. Liquidity. You can't sell a house overnight. It takes time to list, negotiate, and close a deal. Stock market risks. Volatility. Stocks can swing wildly in value. A bad earnings report or global event can cause a sharp drop. Emotional investing. Fear and greed often lead to poor decisions, like selling low or chasing hype. Company risk. If a company goes bankrupt, your shares could become worthless. Market crashes. Think 2008 or 2020. Entire markets can tumble, wiping out gains temporarily. Managing risk. Diversification. Spread your investments across different assets. Don't put all your eggs in one basket. Emergency fund. Always keep cash reserves for unexpected expenses or downturns. Education. Learn before you leap. Understand the market, the asset, and your own financial goals. Professional help. Consider working with financial advisors, property managers, or tax professionals. Risk is part of the game, but so is reward. The more informed you are, the better you can navigate the ups and downs. Accessibility and barriers to entry. One of the biggest questions for new investors is, how easy is it to get started? Let's compare how real estate and stocks stack up when it comes to accessibility. Real estate. High barrier, high reward. Real estate can feel like a gated community, literally and financially. What you need to get started. Down payment. Typically 10-20% of the property's value. That's $30,000 on a $300,000 home. Good credit score. Most lenders require a score of 620 or higher for conventional loans. Stable income. You'll need to prove you can make mortgage payments. Closing costs, appraisals, inspections, title insurance, and legal fees can add thousands. Time and knowledge. You'll need to understand the local market, laws, and property management basics. Real estate is capital intensive. It's not something you can casually dabble in with your spare change. But once you're in, the potential for cash flow and appreciation is real. Stocks. Open to everyone. Stocks are like the public park of investing, open to all, easy to access, and full of variety. What you need to get started. A brokerage account. Open one online in minutes. Minimal capital. Some platforms let you start with as little as $1. Basic knowledge. Learn the difference between stocks, ETFs, and mutual funds. No credit check. Your financial history doesn't matter here. No physical maintenance, no tenants, no toilets, no termites. Stocks are incredibly beginner-friendly. You can start small, learn as you go, and scale up over time. Leverage and financing. Using other people's money. One of the most powerful tools in investing is leverage, using borrowed money to increase your potential return. But not all leverage is created equal, and how it works differs dramatically between real estate and stocks. Real estate. Leverage is the norm. In real estate, leverage is baked into the system. Most people don't buy homes with cash, they use mortgages. How it works. You buy a $300,000 property with $60,000 down. The bank lends you the remaining $240,000. If the property appreciates 5% in a year, it's now worth $315,000. Your equity grows by $15,000 on a $60,000 investment. That's a 25% return on your cash thanks to leverage. Other financing tools. HELOC. Home equity lines of credit. Use equity in one property to invest in another. Cash out refinancing. Refinance your mortgage and pull out cash to reinvest. Seller financing. The seller acts as the lender, often with flexible terms. Leverage in real estate can supercharge your returns, but it also increases your risk. If property values fall or tenants stop paying, you still owe the bank. Stocks. Leverage is risky. In the stock market, leverage comes in the form of margin accounts. You borrow money from your broker to buy more stocks than you could with cash alone. Margin accounts. You deposit $10,000. Your broker lets you buy $20,000 worth of stocks. If the stocks go up, you profit more. If they go down, you could lose everything and owe more. Margin trading is risky and not recommended for beginners. Unlike real estate, where leverage is long-term and backed by a physical asset, stock leverage is short-term and volatile. Taxes and legal considerations. What you keep matters. It's not just about how much you make, it's about how much you keep. Taxes can take a big bite out of your investment returns, and both real estate and stocks come with their own set of rules, benefits, and headaches. Real estate tax benefits and burdens. Real estate is famous for its tax advantages, especially for long-term investors. Tax advantages. Depreciation. You can deduct a portion of your property's value each year, even if it's appreciating in market value. Mortgage interest deduction. Interest on your loan is often tax deductible. 1031 exchange. Sell one investment property and roll the profits into another tax-deferred. Capital gains exclusion. If you live in your home for at least 2 of the last 5 years, you may exclude up to $250,000, $500,000 for married couples of profit from taxes. Tax challenges. Property taxes, these vary by location and can increase over time. Self-employment tax. If you're actively managing properties, you may owe additional taxes. Record keeping, you'll need to track expenses, repairs, and income carefully. Stock market tax rules, simpler but still tricky. Stocks are generally easier to manage from a tax perspective, but there are still things to watch out for. Tax benefits. Long-term capital gains. Hold a stock for more than a year and you'll pay a lower tax rate on profits. Tax-advantaged accounts. Use IRAs or 401(k)s to defer or eliminate taxes on gains. Tax loss harvesting. Sell losing stocks to offset gains and reduce your tax bill. Tax challenges. Short-term gains. Profits from stocks held less than a year are taxed as ordinary income. Dividends, these are taxable even if reinvested. Wash sale rule, you can't claim a loss if you buy the same stock within 30 days of selling it. Legal considerations. Real estate, you'll deal with contracts, zoning laws, tenant rights, and possibly LLC formation. Stocks, mostly regulated by the SEC. As long as you're not insider trading, you're good. Bottom line, real estate offers more tax strategies, but it's also more complex. Stocks are simpler, but you'll need to be mindful of timing and account types. Time commitment, passive versus active investing. Time is money, and how much time you're willing to spend managing your investments can shape your decision. Real estate, active by default. Real estate is hands-on, especially if you're managing properties yourself. Tenant management, screening, leasing, collecting rent, handling complaints. Maintenance, repairs, upgrades, seasonal upkeep. Paperwork, insurance, taxes, legal compliance. You can outsource these tasks to property managers, but that cuts into your profits. Even with help, real estate requires oversight and decision-making. Stocks, mostly passive. Stocks are the definition of set it and forget it, especially if you invest in index funds or use robo-advisors. No maintenance, no physical assets to manage. Automated investing. Many platforms offer auto-investing and rebalancing. Minimal oversight, check in occasionally, but no daily tasks required. If you want to build wealth without building a second job, stocks are the easier path. Personality fit. What kind of investor are you? Your personality matters more than you think. Investing isn't just about numbers, it's about how you feel, how you think, and how you react under pressure. Real estate suits you if you like control and tangible assets. You're comfortable with long-term commitments. You enjoy problem-solving and negotiation. You're okay with occasional stress and unpredictability. Stocks suit you if you prefer simplicity and automation. You're analytical and data-driven. You want flexibility and liquidity. You're comfortable with market ups and downs. There's no right or wrong answer, just the right fit for you. Hybrid strategies, best of both worlds. Why choose one when you can blend both? Hybrid strategies let you enjoy the benefits of real estate and stocks without going all in on either. Smart combos. Rate real estate exposure through stock-like investments. Great for passive income. House hacking, live in part of your property and rent out the rest. Cuts living costs and builds equity. Dividend stocks, like rental income but from companies. Reliable cash flow. Real estate crowdfunding. Invest in property projects with small amounts of capital. These strategies offer flexibility, diversification, and accessibility, perfect for modern investors. Case studies, real people, real choices. Let's look at how different people approach their first investment. Sarah, 28, started with stocks. Sarah used a robo-advisor to invest $5,000 in ETFs. Over 5 years, she grew her portfolio to $50,000. She then used part of that to buy a duplex, living in one unit and renting the other. James, 35, started with real estate. James bought a rental property with savings and a mortgage. He managed it himself, learned the ropes, and now owns 3 properties. He's just started investing in dividend stocks for passive income. Aisha, 40, hybrid investor. Aisha prefers passive strategies. She invests in REITs and dividend-paying stocks. She's never owned physical property but enjoys consistent returns and minimal stress. These stories show there's no single path, just the one that fits your goals and lifestyle. Expert opinions, what financial planners say. Most financial advisors agree on a few key points. Start with stocks, they're easier, cheaper, and more flexible for beginners. Build capital first, use stocks to grow your savings before jumping into real estate. Diversify over time, don't rely on one asset class, spread your risk. Know your goals, retirement, passive income, wealth building, your strategy should match your destination. Experts emphasize education, patience, and planning, no matter which path you choose. Conclusion and action plan, where should you put your money first? Let's wrap it up. If you're just starting out, stocks are the easier entry point. They require less capital, less time, and offer more flexibility. You can learn the basics, build your portfolio, and grow your confidence. Real estate is powerful, but it's a bigger commitment. Once you've got some financial footing, it can supercharge your wealth through leverage, cash flow, and appreciation. Your action plan. 1. Assess your finances. How much can you invest today? 2. Define your goals. Are you chasing growth, income, or stability? 3. Start small. Open a brokerage account. Buy an ETF. Learn the ropes. 4. Educate yourself. Read, watch, ask questions. Knowledge is your best asset. 5. Plan for real estate. Save for a down payment. Explore markets. Build credit. 6. Diversify over time. Blend strategies. Use REITs, dividend stocks, and property when ready. Start with stocks. Learn the game. Build your base. Then when you're ready, step into real estate and let leverage work its magic.